So there's one issue that has started to pop up on some of the current deals we're working on, as well as deals we hear from some of our peer group that I thought would be important to talk about today. So, welcome back to our podcast, The Ins and Outs of Selling a Business, and this week's big hurdle. So, the issue that we're talking about is getting the lender to sign off, the buyer's financing source to sign off on the transaction. What we're seeing is on a couple deals we're working on is we're down to the finish line and we don't have the lender's approval to sign off. Why is that? Well, I think the current state environment we're in right now is giving the lender some pause. They're being ultra conservative in their underwriting criteria, including the covenants and the loan documents that the buyer has to sign off on. So it is, it's kind of delaying the transaction in some regards. I mean, we're still going to get to the finish line, but what's happening is what we're seeing is the buyers are kind of coming to us, meaning the seller, looking for us to solve their problem, right? And how would you solve that problem for them? Is like, well, maybe we'll structure the deal a little bit different. So, whether that's a little bit of an earn out or seller note or some other kind of methodology or structure of transaction that gets the lender comfortable. So, our recommendation is no, right? That's not our problem as a seller. It's the buyer's problem to find a solution internally to fix or ease the concerns of the lender. And that could be a couple things, right? It could be they need to put a little more equity in the transaction. Or they need to give the lender maybe equity interest in a part in a deal, or maybe a higher interest rate. But they should be coming back to you to solve their problem. Now, look, if you have a great opportunity, you have a great structure, the valuation's higher than expected, maybe you give a little bit to compromise. But in reality is that they should not be coming to you at the end of a transaction and say, hey, look, I need you to take a small seller note. I need you to do this. And, the answer is you shouldn't have to do that. You should, we're like a hard no for our clients on that, right? It's like, hey, I'll give you, go back to your lender and figure it out. Again, certain circumstances, if you have a really good number out there, maybe you give a little bit or compromise a bit or help them out a bit. But overall, the majority of it is like they got to solve their own problem. I'll give you a couple examples, right? We have a deal that is going through literally 6 levels of approval with a bank. And they came back to us the other day and said, well, you think they came back to the buyer to the buyer, excuse me. And he came to me and said, our bank was wondering if your client would take a small seller note. And I said, the answer is highly unlikely. He said, we already negotiated a deal. We took a purchase, agreed upon valuation based on not having a seller note. Now, incorporating a seller note is probably going to kill the deal. So my recommendation is you go back to your lender and solve the problem. He told me the other day that they worked it out. Okay, because they're always going to come to you first as the easy solution for you to give and compromise versus trying to figure it out internally on their end. Another area we had is some of the terminology in the purchase agreement related to the seller note, related to the earnout. The lender didn't like that language or had some concerns about the language in there, and they wanted to modify it, right? So we took great pains and care when we negotiated that letter of intent to include the language because we knew this would come up at some point in time, that everybody agreed upon a language of how to determine, in this case, the earnout, right? And so we pointed to that to the buyer, and we said, look, we had a deal. We agreed to this. We negotiated the language here. You can't come back to us in the 24th hour and said, well, our lender doesn't feel this is industry standard, or has some problem with some add backs or how is calculation. I said, you know what? You know, in this case, we gave a little bit, but it didn't change the structure of the transaction to kind of help them. But we said you need to go back to your lender and solve it, which they did. So, hopefully now it did delay the deal a couple weeks. Like I'm saying, these things will pop up, and if you're like everybody's moving at a full steam, especially in like the last 72 hours. There's a lot of stuff going on, a lot of things happening. Everybody's moving full steam. All of a sudden, you hit a hard stop because you get a surprise about that the lender hasn't signed off with the buyer yet. So we start very early in the process. We want to see the proposal letter from your bank. We want to see the commitment letter from your bank. Again, they're only as good as the paper they're written on. But we want to know where they stand so we can monitor it because you're spending a lot of money on legal fees, spending a lot on accounting fees, consulting fees, whatever, to get the deal done. And so you don't want to be in a position where you get the surprise that the buyer, has a buyer's lender wants to change the deal structure to fit their needs, right? You, as the buyer of our company, need to solve that problem on your own. We'll give and we'll try to make concessions in areas that are not going to be what I would call financial concessions, maybe a little bit in the wording of the language. We'll try to work with you, but overall, if it changes the dramatic structure of the deal, we're out. Right? As we said, we were out. We're not doing it. And lo and behold, what happened? They solved their problem. So as a seller in this market, pay close attention when a buyer is looking to buy your business and make sure they have a track record of successes. Doesn't mean the next deal is going to be successful, but they have a track record of success in borrowing, whether from a traditional lender or private capital, private credit, which is essentially a private equity fund that provides debt financing versus equity to deals. Understand how they're going to finance a deal and make sure and check on it like weekly as you're going through a transaction that they got their financing and their funding lined up. Because you get to the last week and the lender is out there and asking for a concession on your end, you know what? You're likely going to be very upset about it. It's not going to work for you. You're probably going to pull back and, say no, kill the deal and start something and find another buyer. And that's a lot of time, effort, and money again. So really focus on how the buyer's financing a deal so you can, as a seller, as us, Osage, representing you, it's like we're on top of that all the time, is making sure that we get there. So I hope you find this information valuable. It's very important, especially when you're in a very tight lending environment versus 5 years ago when money was easy and free, so to speak, for 3%. Today, it's a different ball game. Focus on understanding every aspect of how the buyer's putting their deal together so you have a successful closing. Again, my name's Keith Dee. I'm president of Osage Advisors. I hope you enjoyed our big hurl today. If you like it, you can subscribe to our podcast, The Ins and Outs of Selling a Business, on YouTube. If you have any questions about today's conversation, feel free to give me a call at 860-767-3273, extension 1001, or shoot me an email at kdee@osageadvisors.com. And feel free to visit our website at osageadvisors.com for more information on our company. Thanks again and have a great day.